A $26.5 billion IPO popped 15%. A bond auction quietly out-argued the Fed, and Meta erased its entire year in 5 trading days. That's the week, and we haven't even gotten to the part where a president declared a ceasefire over on live television and the market shrugged. Good morning. It's Saturday, July 11th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. This is the weekend edition, the week graded. No preview today, no what to watch Monday until the very end. We're grabbing the whole week, laying it on the table, and grading it, ourselves included.
Which is my least favorite sentence you say all week, and you know it.
Speak for yourself. I've got a genuinely good week to talk about buried in there somewhere.
We'll get to whether that's true. 4 threads today. The chip trade's wild swing back to Meta having its best week since early 2024. The Iran story that kept threatening to break the tape and never quite did. A bond auction that told you more than the Fed minutes did, and a market that hit records while a huge chunk of it quietly went nowhere. Plus the scoreboard, which is where we're starting, because that's the whole point of Saturdays now. Where do we stand walking in, Eleanor?
2-2 on the season, streak of -1. Not great, not humiliating.
Marcus.
1-4 coming into today. Bad. I'm aware it's bad.
There's one call still live from yesterday, so let's close it before we grade anything else. Marcus, SK Hynix, you said it closes green on debut day, or the memory trades ahead of itself.
And?
Priced at 149, opened above 170, pushed toward 175 before the bell. Green, and not by a little.
There it is, finally.
Oversubscribed more than 7 times, by the way. I pulled that after the show yesterday. 500 plus investment firms wanted in. That's not a stock popping on thin float. That's genuine, broad-based demand for direct memory chip exposure outside Micron.
Which is the whole thesis I've been defending all week, while Micron made me look like an idiot for it.
We're getting to that. Win, on the record. Marcus is 2-4 now. Streak flips to +1.
I'll take a +1 streak of 1. It's still a streak.
Eleanor, your one open item. Wells Fargo's net interest margin Monday morning needs to hold flat or better, or the debt relief trade you've been worried about all quarter starts showing up for real.
Still live. Can't grade a number that hasn't printed. That one carries into next week.
Fair. So here's where the season sits after today. Eleanor 2-2, streak -1. Marcus 2-4, streak +1. Sarah and Dave sitting this week out entirely, still 0-0 and 0-1 with a -1 streak respectively.
They're not even here to defend themselves?
That's sort of the point of an empty chair.
Now the part I actually want to spend time on, call of the week and miss of the week. Not just who won or lost a coin flip, but who got the actual thesis right and who got it backwards in a way worth learning from. Marcus, you're up first, and I think you know why.
The SK Hynix call, obviously, but I'd frame it bigger than the ticker. Every single day this week, I lost a Micron call. Above 1100, above 1000, just closing green. Lost, lost, lost. 3 separate ways of betting on the same DRAM supercycle thesis. 3 separate losses.
And yet
the thesis was never wrong. The AI memory shortage is real. The pricing power is real. I just kept betting on the one stock getting hit hardest by every other headline of the week. SK Hynix showing up with a $26 billion IPO and getting bought 7 times over is the market finally pricing the thing I'd been saying all along. Right trade, wrong ticker for 4 straight days.
I'll actually back him on this one. It's a good distinction. Being wrong on execution and being wrong on thesis are different kinds of wrong, and this week he was only guilty of the first one.
Call of the week. Marcus, SK Hynix, the DRAM supercycle finally getting its receipt. Now the harder one. Eleanor, miss of the week is yours, and I don't think you'll fight me on it.
I won't. It's the 30-year auction.
For anyone who missed Thursday's show, walk it through again because it's worth understanding, not just grading.
I built the call as a binary. If the auction tails, prices above where the pre-auction market had it, that's real fear showing up as weak demand. If it comes in clean, the fear was overstated. Thursday's auction did neither. It priced at 5058%, the highest award on a 30-year in almost 20 years. Genuinely scary headline number. But it stopped through, meaning it actually priced better than the when-issued market expected. The tail was smaller than dealers were braced for.
Translate that for the room.
It means buyers showed up anyway. A weak auction looks like a fat tail and a yield that blows past where trading had it going in. This was the opposite. The market took the highest long bond yield in 2 decades and said, fine, we'll take that yield, here's our money. That's not a fear signal, that's confidence in price discovery.
So, where did the call break?
I gave myself 2 boxes, scared or not scared, and reality needed 3. Scary headline, calm mechanics, both true at once. I didn't leave room for that, and it's exactly the kind of nuance I usually push Marcus to make room for. Own goal.
I'm allowed one moment of enjoying this, right?
Ha.
Miss of the week, Eleanor, the 30-year that scared everyone on the headline and reassured everyone underneath it. Genuinely, the most interesting single data point of the week, win or lose. Let's build on that, because it's thread 3 today. But first, the story that actually moved the most money. Monday, memory chips roared. The Dow hit a fresh record above 53,000, and Nvidia was the one name sitting it out.
Which should have been the tell all week. UBS pushed its DRAM deficit call out to 2028, Citi and Beauvais both raised targets, and the whole memory complex, SanDisk, Western Digital, Micron, ripped higher on a single Foxconn earnings beat. One Taiwanese contract manufacturer's numbers moved hundreds of billions in market cap Monday. That's how concentrated this trade still is.
And Nvidia lagging a 3% surge in the Philly Semi-Index on a rumor about a chip architecture delay is its own signal. After 2 years of the whole AI trade moving as one name, investors started pricing execution risk stock by stock. That's not nothing.
Then, Tuesday it all came apart.
Tuesday was ugly. Philly Semi fell more than 5%, Micron dropped roughly 5%, Samsung slid 10%, and Seoul the same day reported a 19-fold profit jump. Good news, sold anyway. That's a valuation reckoning, not a fundamentals problem.
Wednesday didn't help. Ceasefire collapse, oil spiking, chips getting hit again on top of the Fed minutes landing that afternoon. By Wednesday's close, the Dow was down over 500 points off the highs and back under 53,000.
And then, Thursday flips again.
Thursday, semis just rallied straight through the Iran headlines. Micron plus 7%, SanDisk plus 7%, Marvel plus 5.5%. Chips over conflict was the actual headline, and it was accurate. The market decided a real military escalation was less relevant to price than a sector finding its footing.
Which by itself would be a strange week. Then Friday happens, and it's not just chips holding up. Meta puts up its best week since early 2024, 15% in 5 sessions, and it erased the entire year's losses in one stretch.
Give me the mechanism, not just the number.
3 things stacked on top of each other. Muse Image launched Tuesday, a new AI image model aimed at creators and advertisers. Muse Spark 1.1 came Thursday, built for coding and agent workloads, and it shipped with a public developer API. Zuckerberg's own comparison was pricing it at roughly a quarter of what Anthropic and OpenAI charge for comparable access. Then reports that Meta's own chip, codenamed Iris, starts manufacturing in September, part of a push toward 14 gigawatts of compute next year.
That third one's the real story for me. Meta spending on custom silicon reframes 2 years of their burning cash on compute into they're building a moat and now selling the extra capacity through a new cloud unit. That's cost-centered a platform bet, and the market re-rated it in a week.
I'd still flag the size of the move. 15% in 5 days on 3 product announcements, none of which are revenue yet, is a lot of multiple expansion for a story that's still mostly a promise.
Sure, but Broadcom extending its custom chip agreement with Apple through 2031, the same week, on top of existing Alphabet and Meta tie-ups. That's not one company's promise. That's the whole custom silicon supply chain, getting a multi-year commitment. Applied Materials, Lam Research, KLA all up more than 4% behind it.
So strip the headline whiplash out. Monday roar, Tuesday rout, Wednesday worse, Thursday recovery, Friday breakout. What actually survived the week?
The thesis survived. The DRAM shortage, the AI infrastructure build-out, the custom silicon shift, none of that got disproven by a 5% Tuesday. What the week actually tested was which names have real books versus which are riding sentiment. And Meta, SK Hynix, and the equipment names came out the other side with receipts. Micron's chart just had a rougher few days getting there.
Philly Semi's up something like 47% year-to-date now. I'll let that number do the talking.
Let's turn to why Tuesday and Wednesday got so ugly in the first place, because it wasn't really about chips. Sunday night, President Trump said the ceasefire with Iran was over. Strikes into the night, Iran hitting American positions in the Gulf, the U.S. revoking the waiver that had let Iran keep selling crude. That's the setup for the whole middle of the week.
And the market's response was genuinely strange if you never watched this trade before. Brent spiked to around 78 Wednesday on the disruption fear. Then, Thursday with the US. Hitting something like 90 targets inside Iran overnight, actual escalation, not just rhetoric. Crude actually pulled back because tankers kept moving through the strait.
That's the whole lesson of the week in one sentence, honestly. Markets don't price the war, they price the tradable variable. Trump can say a ceasefire's over, Iran can hit a base, and none of it matters to the tape until a tanker actually gets hit or a pipeline actually closes. Insurance rates on Gulf shipping spiking, that's the real-time read. Everything else is a headline.
I'd push on that a little because SOFR is carrying a lot of weight in a 4-session winning streak for that logic. There are still, by some reporting, thousands of sailors stuck in the Persian Gulf more than 100 days into this, unable to sail out. The physical risk hasn't resolved just because price hasn't reacted to it yet.
That's fair, and it's not nothing. I don't want to wave that away. I'm talking about how the tape prices it, not whether the underlying situation is actually fine. Those are different questions.
Devil's advocate for a second. At what point does the tape shrugs it off? Just become complacency dressed up as sophistication?
Honestly, I don't have a clean answer. My best one is what I said Friday. Watch Gulf shipping insurance, not headlines. The day that spikes is the day I stop calling this contained.
And by Friday, where did it actually land?
Renewed talks reported between the US and Iran. Crude eased back toward 72. The 10-year eased for a second straight session to about 454. The VIX remarkably ended the week at 15.84, down over 6% from where it started, through an actual military escalation. That's either a market that correctly triaged a contained energy story, or a market that's gotten too comfortable pricing tail risk. I genuinely don't know which yet.
Neither call gets scored today, but file it. We'll be revisiting Hormuz insurance rates the next time this flares, because it will. Let's get back to the bond story properly, because Eleanor's miss was really a symptom of a bigger split this week. Wednesday's FOMC minutes were the first real look inside Kevin Warsh's Fed since he took the chair, and the headline is, "The committee is a lot less unified than his own hawkish hold led on."
12-0 on holding the rate at 350 to 375, but underneath that unanimous vote, participants judged inflation risk tilted to the upside. And this is the number that matters. Nearly half the committee is now on record wanting another hike before year end. Goldman's already pushed its own rate cut call out to 2027.
Which is the tension nobody's resolved. A payrolls miss 2 Mondays ago said the labor side's cooling. The minutes say the inflation hawks have real numbers behind them now. Warsh himself gave zero personal signal, no dot, 30 seconds at the podium, which either means he's deliberately letting a split committee speak for itself, or he genuinely doesn't have a strong view yet.
And then the bond market answered a day later, with the 30-year we already covered.
Right, and I'd add the context I didn't have room for Thursday. Investment grade and high-yield credit spreads are both sitting near multi-year tights, well under the level that usually flags late-cycle stress. If the market believed the hawkish minutes were the start of something that breaks credit, spreads would be widening. They're not. That's the real tell, more than the auction headline number itself.
So, bonds are pricing higher for longer, not recession.
That's my read, yes. Which is actually a decent setup heading into bank earnings. Higher for longer is good for net interest margin if it holds, which is exactly why my Wells Fargo call matters Monday.
Give me the plain version for anyone who just wants to know what to watch. Why does a bank's net interest margin care about any of this?
Banks borrow short and lend long. When short-term rates stay elevated and long rates hold up too, the spread between what they pay depositors and what they earn on loans can either widen, good for the bank, or get squeezed if funding costs rise faster than what they're earning. Wells Fargo Monday is the first real money test of which direction that's breaking.
Cut that thread there, we've got one more big one. But Marcus, quickly, does the split committee change how you trade chips at all?
Not much this week. If oil forces the Fed's hand toward another hike because energy inflation won't cool, that eventually raises the discount rate on every long-duration growth name, chips included. Eventually, not a 5-day story.
Last thread, and it's the one I think gets buried under all the record headlines. Small caps had a genuinely bad week underneath a genuinely good-looking year.
Russell 2000 fell Friday and underperformed the broader market for a second straight week. And the index is still up more than 21% year-to-date, its best start since 1991. Both of those things are true at once, which is exactly why I don't trust the headline number by itself anymore.
I've been on the other side of this all week, and I'll stay there. Capital has been leaking out of the most concentrated mega cap AI names into everything else all year, not just this week. That's a healthier market underneath a scary-looking rotation, not a warning sign.
Here's my actual pushback, and it's not going away just because I lost an auction call. The Dow finished the week down roughly 0.5%, even after touching a fresh record Monday. The S&P's up on the week entirely because of Meta, a couple of chip equipment names, and one optical supplier. That's not broad participation, Marcus. That's a handful of stocks doing all the lifting, while the VIX sits at multi-month lows. Narrow leadership plus a complacent vol print is the combination that's bitten people before.
And small caps up 21% year-to-date on a best start since 1991 isn't broad participation either. You can't have it both ways. Either rotation into the Russell is real breadth, or it isn't.
It can be real on a 12-month clock and still fragile on a 1-week clock. Those aren't the same claim.
I'm not going to make you two resolve this because I don't think you're actually going to, and I'd rather you not fake it. Here's a tiebreak for anyone listening who wants a level, not a vibe. Watch the Russell against the S&P starting Tuesday, when bank earnings actually land. If small cap financials rally alongside the majors on real numbers, Marcus's healthy rotation red gets real support. If small caps lag even as the majors hold near records, Eleanor's narrow leadership concern is the one aging well.
I can live with that framing.
Same. Genuinely don't know which way it breaks.
Good. That's what an honest disagreement is supposed to sound like. Quick human moment before we close, because it's been a heavy show. Eleanor asked me Thursday about my pour-over streak.
The trend Marcus wouldn't call a trend?
I conceded that one. 4 points is a trend.
It's dead. Saturday morning, I timed myself making coffee for my own amusement, and it took 11 minutes because I got distracted reading Friday's after-hours notes. So the streak's broken by the podcast itself, which feels appropriate.
That's almost poetic.
I'd call that a loss, actually. You should log it.
Noted, unofficially. Back to business for 30 seconds. One thing carries into Monday, and it's the only live call on the board. Wells Fargo's net interest margin, first thing Monday morning, kicking off bank earnings alongside JP Morgan, Bank of America, and Citigroup. Eleanor needs it flat or better for her case, and it's the first real data point in the small cap breadth fight we just left unresolved. That's genuinely it for what we're carrying forward. Everything else this week is graded, filed, and closed. If the show helped make sense of a genuinely chaotic week, follow Nova Ventures Daily wherever you get your podcasts, and catch our daily charts and reels on Instagram at NovaVentures_US. That's the week graded. Eleanor's 2-2, Marcus climbs back to 2-4, and we'll see you Monday for bank earnings in the next round.